Hello, ambitious dentists. So in this video, I'm going to explain the age-old question that everyone stays up at night trying to answer, which is, can a dentist write off the vehicle that they use for their business? Short answer is yes. Long answer is, it depends, just like every video that I do. So in order to be able to fully explain this, I'm going to talk about some foundational definitions to help you better understand, so that if you have a specific question, you may be able to answer it yourself, as well as I'm going to go over a couple examples and then tell you really what happens in reality for most dentists. Okay, so to get to the foundations of what we're talking about, the first definitions you need to know are what the IRS looks at. So number one, the IRS defines all miles driven on your vehicle as one of three different categories. The first one being personal miles, which is basically driving around town for your own benefit, which is going to taking your kids to soccer practice, going bar hopping, whatever it is you do at nights. Those are personal miles, as long as there's no relation to business. The second is commuting miles, which is specifically driving, from your place of residence to your place of work, or driving from your place of work to your place of residence. That's very specific, very easy to understand. It is what it is. Those are called commuting miles. They're specifically defined. And the last one is the third one is business miles. So the business miles are the ones where most of the confusion comes from. So business miles are driving from your office. Sorry, it was this one, your office over here, specifically to other places of business. So meeting with your marketing company, meeting with your CPA, meeting with your attorney, talking to, networking with other dentists, going to CE events, driving around to, if you're going out of town, you can go from your home, but going, anything that is business related. So that's the very first thing. You have to understand those definitions in order to be able to get to wherever else we're going in this discussion. Because at the end of the day, what you're really asking is not, can I deduct something? It is, how much can I deduct? And to be completely honest with you, if you have a CPA that is saying you as a dentist cannot take a business mile or take any type of auto deductions, then you don't need that CPA. That CPA isn't listening to you and isn't understanding your business fully. You can reach out to us. We do this every day with our CPA firm, Dentist Metrics. So when you come to think of those different types of things, you're thinking of it as the total use of your vehicle for the entire year. And that's how the IRS looks at it. That's not just me saying it that way. You're actually looking on paper, okay, to say, like, for example, if you had a car on January 1 that had 0 miles on it on the January 1st, and at the end of the year you had 12,000 miles on it, you look at that as in total 12,000 miles driven on that vehicle. What the IRS wants to know, and what they are perfectly happy giving you, is to say, okay, what percentage of the time did you use that vehicle for business? And it's not time-based, it's very quantitated. It is, of those three different categories we talked about, it is how much did you use for business miles compared to all of your miles. So let's take an example. Let's say let's say you had 12,000 miles. Let's say you had 3,000 that were business miles. Let's say that you had 3,000 that were commuting miles. Let's say that you had 6,000 that were personal miles. What percentage of the time did you use that vehicle for business purposes? It's 25%, 3,000 divided by 12,000. So what can you deduct? Well, you can deduct really pretty much anything when it comes to the use of that vehicle. So for example, you can do gas, fuel expenses. You can use detailing of the car washes, insurance, property taxes, interest on note payments. You can do, significant repairs, et cetera, et cetera, et cetera. The list just goes on and on, which you can use for that vehicle. You can also write off a piece of the purchase price of that vehicle over time, as long as you follow some certain guidelines. And we'll get into that in a little bit, because that's actually pretty big mistakes that people make in those regards. So that is, how you write it off. You have to keep up with the number of miles driven. Because if you don't, then the government can say you can't prove that that's what you actually did, so we're not going to give you this deduction. And so for that, I typically recommend people keep up with their mileage through something like something with their phone. Just keep up on your phone with like a Mile, I think Mile IQ, Expensify, different apps like that. There's a bunch of really good ones right now that can help you keep up with this pretty simply. But that's how I tell people to keep up with those. So, but back to the example. Let's say over the course of a year, you have $5,000 in expenses that are related to that vehicle. That is the amount that you would have in, gas and repairs and insurance, etc. What do you do at that point? You add all those up, the $5,000, you take your business use and times it by that total, and you have your auto write-off. So just like $5,000 in expenses, 25% of that would be $1,250 in expenses that you'd get to write off. So pretty simple of how to do that whenever you take it into that context. The next piece is, and this is the part that you have to add on, is the actual purchase process of that vehicle. You can depreciate, which is depreciation basically just means that you're writing it off over a long period of time. You can depreciate the use of that vehicle. So let's say you bought a $25,000 vehicle and you can fully deduct the purchase price of that vehicle over time. That's the caveat. It has to be over time. The second caveat is that the IRS has some very strict rules about the write-off of your vehicle. Number one, if you use it less than 50% of the time for business, you have almost no leeway to do any special type of depreciation, accelerated depreciation types. And most dentists don't typically go above that 50% threshold. Some do 100%, but most do not. So if you're not able to use those special depreciation items, you're really limited to only a couple $1,000s a year in depreciation from your vehicle because of this really old law called luxury auto vehicle purchases. I don't know if that's the actual law, what it's called, but essentially the government says if you purchase a vehicle that's over something like $12,000 in cost, it's classified as a luxury automobile. And yes, $12,000 or whatever the number is not a ton. They actually came up with this law like in the early 80s or something like that, and they never updated the definition or the dollar amount threshold that goes with the luxury auto definition. And so for that, if you have a luxury auto, then your depreciation is limited to just a couple $1,000s a year, and you only get 25% of that. So because of the business use, so 25%, let's say $2,000, you get $500 more on that. So then at that point you get $1,750 in deductions towards that vehicle. Now there is a downside to that, is that whenever you go to sell that vehicle, whenever you go to trade it in, you have to recapture some of that depreciation, which could end up giving you a gain on the trade-in of that vehicle. And yes, you can wrap it into a like-kind exchange type thing, which is somewhat complicated. We won't get into that too much, but just believe me when I say that benefit of being able to write the vehicle off over time is a really, really big misconception for most people, thinking, hey, I want to write off my vehicle, have Uncle Sam pay for my new Lexus. It just doesn't typically work out that way. So again, let's just assume that you're going to get the full $1,750 deduction that we talked about, and we're not going to take into account any of the gains that you're going to take on in the future, which is something you do need to consider. But you also have to keep up with all the records. You have to keep up with the business mileage. You have to keep up with the total mileage. You have to keep up with all the records and all the receipts of all the auto expenses, of the gas, of the repairs and maintenance, et cetera, et cetera, et cetera. You can't just keep a credit card statement that has who you paid for it. That doesn't count. You have to have the actual receipts and keep copies of them and everything like that, as well as you have to have that mileage log that we talked about before of keeping up with the number of miles driven and number of business miles, etc., to get the $1,750 deduction. Not a ton, but it's better than nothing. So you have $1,750 in deductions. There's also an alternative, which I know probably a lot of people have heard about, which is to take the standard mileage rate. So in our example, we had 3,000 business miles driven. The IRS actually says, hey, rather than keeping up with all that other junk, we're just going to allow you to deduct a certain amount per mile that will cover the deduction related to the business use of that vehicle. So, and like, for example, it's somewhere around 55 cents a mile. I don't know what year people are going to be looking at this, but it's somewhere around 55 cents a mile. So on 3,000 miles, you're looking at something like $1,650 in deductions. So almost exactly the same as that $1,750, but there is one caveat. On the standard mileage rate, that includes depreciation in their calculations. So you don't have, when you go to sell that vehicle, you don't have to recapture that depreciation. So you're actually getting a bonus for using the standard mileage rate that not many people realize. So what you do is you take the number of your actual expenses, which in our example is $1,750, versus the standard mileage rate, which in our example is $1,650, I believe. Let me just pull up a real quick calculator and make sure that's the right amount. Yeah, $1,650. So so you take $1,750 versus $1,650, and you choose which one you want to use. Most people opt for the standard mileage rate because if they do the standard mileage rate, they don't have to keep up with all those receipts or anything like that. They just have to keep up with the mileage log, which you have to keep up with anyways. And so that $100 deduction, for the most part, for most people, isn't worth it for them to keep up with everything. So again, that's just a brief example of that. Now, if you use your vehicle for more than 50% of the time, then the pendulum starts to shift more towards using it on the actual numbers. And the reason being is it because whenever you get over 50%, you can use some accelerated depreciation to get in the very first year. And again, it's only in the first year that you can use some special depreciation rules. Number one, there is a thing called just special depreciation, which means you can write off a lot of the purchase price in the first year. However, if it's a luxury auto, then you're limited to only like $7,000 or $8,000 in bonus depreciation, special depreciation in the first year. If you have a luxury vehicle that is over 6,000 pounds, which is only the biggest of SUVs, then you can take 179, which is a really good one, but most people don't qualify for that. So over 50%, you can use special depreciation as well as 179. In order to do 179, you have to have over a 6,000 pound vehicle in order to be able to qualify for that. So that's a real quick caveat. Talk to your CPA about that if that's a specific example for you. And then lastly, we're going to talk also about leases. If you're leasing a vehicle, let's say it's $500 a month. So take 500 times 12, that's $6,000 a year in leases. Same rules apply. You take the 25% times the 6,000 and you get that deduction. So 25% times 6,000 is $1,500. And so that would be your actual, you'd be able to add in the gas and all the other things as well. And so that makes the leasing a little bit closer as far as getting more in the actual department of making that decision between actual and standard mileage rate. But another question I typically get is it better to lease because of that than to buy? And the answer is really no. Most of the time, it really depends on what your personal views and philosophies are on owning the vehicle versus leasing the vehicle. Most people, it's better for typically to own the vehicle because you get that trade-in value whenever you come back for it. But it changes from situation to situation depending on a lot of different factors, and that's usually more of a personal decision than it is a business decision. The deductibility of the lease payment should never really cross you over one line or the other whenever deciding on to purchase or to lease a vehicle. And so finally, the last thing I want to kind of talk about, there's a couple of misconceptions, is that there are a lot of people that have a buddy that has been told they can write their vehicle off from a CPA, and they come to us and say, "Hey, my friend did it. Why, can we?" And honestly, that's what typically happens on that. That's a misconception. There's a lot of CPAs out there that will tell a client, "You can pay for this out of your business account," but that doesn't mean they're getting a deduction for it. That doesn't mean they're getting to write it off. And if they are writing it off, a lot of the times they're out of compliance and they're really asking to be audited, as well as to pay a lot of interest and penalties, and maybe even some negligence fees if they're actually writing the whole thing off one way or the other. So I wanted to kind of touch on that real quick, make sure that was actually explained. So anyway, I hope this video has been helpful to answer the question of, can I write off the use of my vehicle as a dentist? And again, the answer is 100% yes. The caveats that are part of this are definitely it depends, but at the end of the day, yes, you can. You should be taking this deduction. It's a valuable one. Whether it be the standard mileage rate or an actual expense, you should be using that. There is, one other thing that that a lot of people know about, and some people don't, is that you can do a trick to change your commuting miles into business miles. And that is, if you have a qualified home office, then you can change that definition that I talked about in the beginning of going from home to work to go from your home office to your work office, which would then qualify as business use. So in the example we had of being 3,000 miles of business and 3,000 of commuting and 6,000 of personal, that would change the equation to say 6,000 of business to 6,000 of personal, assuming that you had a qualified home office that you were traveling to and from to do your work during the day. Very specific circumstances are involved in there. Much longer video in order to be able to explain how to use a home office deduction correctly. But I wanted to throw that little tidbit and hint in there to allow you to potentially maximize your deduction.